Hey, hey, what's up, guys? Chad.
YOLO,
Yo,
hello.
yo. It's been a while. How are you guys doing?
Welcome back, Chad. It has
Doing
been a
well,
while.
doing well.
Yeah, it's good to be back. I was listening to one of the recordings of you guys just like the other day, but I haven't had the pleasure to join you in a bit.
Great to
Cool.
have you back.
Yeah, I love having you on, man. Oh, by the way, I'm just so everyone knows, I'm working on getting everything uploaded to like an RSS feed, so that way, hopefully these episodes should start going up on Spotify and like Apple Podcasts and stuff. I got to figure all this stuff out. I've never done this before, so figuring all this stuff out. But I should have an archive. I mean, I do have an archive of every single episode that's ever been recorded, so we'll have everything up on something. So working on that as we speak. So then people don't just have to listen to this either on X or YouTube, which kind of sucks for some people. If you listen while you drive or something.
Yeah, check out transistor.fm, I think it is, or transmitter or transistor. I can't remember what it's called. For podcasts like hosting and stuff like that. Makes it real easy.
All right, cool. Yeah, I'll check something like that. I did upload everything to a website. Now I was going to figure out how to start publishing and then get it approved on like Apple and that kind of stuff. But shouldn't be too crazy, and then people can listen more conveniently, not have to deal with all these stupid apps.
Nice, yeah, that'll be cool. Can just do like 2x speed on Spotify or something.
Yeah, exactly. Because I'm sure like that's probably the ideal way to listen to this podcast, honestly. So,
Just like furiously skipping the beginning. Just kidding. So what's on the agenda? What's new?
well, we pinned a tweet up on top here. CoinGecko. Well, I mean, I'm sure anyone that's been paying attention has noticed that THORChain's been pretty consistently top five dexes in the past, like couple of weeks, probably about the past month or so. And yeah, I mean, it's great to see things trending like up and to the right in that direction because that's really the one of the most important metrics that we got is just comparing ourselves against other decentralized exchanges. And hey, volume's been pretty great for the past like month at least, and consistently climbing up there. So like the CoinGecko tweet pointed out that we were top five in trading volume. I don't know what over what time period that is. I guess January to September 2023. And yeah, I mean, we still got a ways to go to flip Uniswap over that time period, but we're on track.
That's awesome. Yeah, and it's great just to see these bigger press sources like having THORChain on the radar, because I know there are probably times where like the volume should have made a top list and like it wasn't even on the radar. So I feel like THORChain is firmly in the zeitgeist now, which is that alone is pretty cool.
Yeah, part of why I think that's so tough is because all the analytics sites, they're all just Ethereum sites, and like obviously because obviously that's also where 95% of activity was. Obviously like it's kind of it's been proliferating out more and more. But like everything is just built to just like look at an ETH contract, say like, oh, this is how much ETH is going in and out, and we can exactly figure out how much volume is going on this exchange by looking at this contract. But it's like everything THORChain is like a completely new paradigm and stuff like that. So yeah, I mean it is interesting because even to look at all this stuff, you have to go on like THORChain.net or like THORCharts or something like that. Although, like CoinGecko does look at our API and things, but you can't see all the stats like as cleanly or as easily because you need kind of like custom tooling built out.
And I think part of it is from the growth of the last like quarter is from just like the active swapper count has been like consistently growing fairly consistently for a good while now. And I think that's just we're getting a lot more volume in part just because a lot more people are actually using the protocol.
Yeah, I mean, I have to assume like streaming swaps is the big lever that took it to the next level. In addition to that,
Yeah, streaming swaps and Trust Wallet for sure. I think streaming swaps help with the diversity a little bit because I've been seeing a lot more like bigger swaps coming through like Shapeshift and AsgardX because like in the past you'd see them pretty much only come out of ThorSwap, and now we're kind of seeing them come out of a lot of different exchanges. We've seen some big ones come out of Rango and DeFi Spot as well, and obviously the user count is just crazy with Trust Wallet, and that's been like vertical up and to the right pretty much all year.
and they just added streaming swaps, right? Or only on Android, I think so far. Is that right?
Yeah, right now it's just on Android. Their approval process for iOS just takes forever. But so Android gets all like the latest and greatest, but there's actually more swap activity that comes out of iOS. So yeah, it's not live on iOS yet, but that will come eventually. And they also added the Nine Realms transaction tracker to Android, so uh, if you do make a swap there, you're not just like left in the dark. And they just because what they used to do is just give you like a block stream link, which tells you absolutely nothing. It just tells you, yeah, you sent the Bitcoin, and you're like, all right, well, what happened to it? Like, it's been a little while. So now they should have a link to the Nine Realms transaction tracker, so they can like users can at least know, what's going on with their swap, like what's the estimated time to receive it, and all that good stuff. So updates coming on that side. Oh, guess Chad
Uh-oh,
just got rugged.
lost Chad.
Yeah, but anyway, things are like really good with Trust Wallet. Like it seems like every single month it's just more and more users using it, and it also seems like it's something that they're really like advertising as a like it's a core feature of the wallet at this point to do swaps and things like that. And obviously we're one of the major providers for that. So I mean, you could just think about like how many users that Trust Wallet has. That is like a fraction of all of the other wallets that are out there that like have the potential to add THORChain cross-chain swaps. So it's like you look at thousands and thousands of unique users a month doing millions per month in volume. You multiply that over just a couple wallets, or even bigger wallets than Trust Wallet, and things start to get pretty nutty pretty quick when you think about like the potential volumes there. And obviously these are like bear market volumes too. So that's why it's like ever since we got the Trust Wallet integration in the first place, it's been pretty hard to be like pessimistic on where things are going because the dominoes start to tip, and then other protocols or other wallets and dexes see the other big guys integrating, and then it just becomes that much more inevitable. So Yeah, I mean that's kind of my thinking about this whole thing. Is just like this trust wallet is just one trust wallet. We have the potential for like like dozens of trust wallets.
Yeah, and then the growth of those too. Like you said, like these are bear market. Well, maybe not the last week, but in general, it's been bear market volumes. So like just it's cool to imagine where trust will be, where all the other trusts will be, and it's also funny just like how they can really use the same marketing angles that like THORChain, THORSwap, everyone puts out there. It's like everything about these crazy execution prices on streaming swaps. That's a huge message coming from a platform like Trust that has what tens of millions of users, whatever it is, to be able to put out a message like that, like, hey, you can get better price execution on any size swap, 100 Bitcoin, whatever you want, like on from your own self custody wallet, like in your pocket, not through a centralized exchange. Like that message being propagated by all these different platforms is huge.
And I think what's really going to speak to a lot of people is once Trust flips fees on eventually, that's going to start showing really the earning power of THORChain, and like you're not going to be able to ignore those numbers when they come out. Just ran some numbers here like a little earlier today. If they collected 70 basis points per swap over the past month, so October 1st to November 1st, they would have earned 550K over that 1 month period. So I mean, you can just think about like that's very material revenue coming in for like a wallet like that, and you can't really ignore that kind of revenue.
At what percent fee was that?
70 basis
Okay.
points.
Yeah, that's
So you
yeah.
can change the numbers as you will. You bring it down to 30, and it's like 250K or something like
Yeah.
that, 200K.
I mean, yeah, at that calculation, that's like 6 million a year in profit for them. Not bad.
Yeah, just raw profit. There's no expenses that go into powering a THORChain swap from their end.
Yeah.
That's amazing.
So it's like, I mean, other wallets are going to start seeing, wow, like these guys are collecting an insane amount of revenue from using THORChain, and like that's just going to continue on like the snowball, like avalanche down the hill type thing, in my opinion.
Then
And even THORSwap powering like a lot of revenue. Like THORSwap is like I would say like by no means like a household name in anywhere besides like the THORChain space. Although obviously it's like quickly growing to that level. But I think the THORSwap takes very material revenue off of especially all the big swaps that they do.
Yeah, I think it was you, Cow, brought up a point on maybe the last time you guys did this that I wasn't here, like about Uniswap now charging a platform fee, and that making the calculation of doing even ERC20 swaps on, say, Uniswap versus THORSwap, like makes that more competitive. So even that's pretty interesting to potentially, just to think like how much more volume THORSwap and other dexes like that could gain when volumes really are going crazy. Long way to go for sure.
so what's next on the docket?
Let me check the docket.
Whip out the clipboard, the docket.
Let's see what we got here. Yeah, you said there's 3 billion in trade volume in October.
Yeah, it's like over 3 billion, and it's like I think our largest month ever, and and some of that's from like nefarious actors out there, and a lot of it's not, and I think just because logic is streaming swaps we were talking about earlier, all these things, but like the fact that it's getting this much adoption in a bear market is pretty crazy. Like it must be even more insane once we actually get to the bull.
Yeah, hopefully just an inkling of what's to come. I guess further than that, I think this happened after the last space that we did. Streaming swaps and streaming savers are live, so those are like both accessible by anybody right now. Although I think they're still waiting to update that, but you can take it out on Lens. It's live in the protocol, and streaming Saver is obviously live. And I've seen some massive deposits on Savers since that's been going live, especially like USDT. I've seen some Bitcoin Cash whales coming out of who knows where, depositing into Savers.
The Bitcoin Cash whales come out of their hole.
There's one.
Yeah. Some Bitcoin Cash that hasn't moved in 7 years.
That's crazy.
There was never anything to do with it until now. So
they showed up.
Those features are basically just like they're just unleashed at this point. Like now, it's just there's no cap to them in some sense, right? In terms of like liquidity coming in to use them.
totally. How big were some of those deposits you were looking at?
Yeah, I saw. I think the biggest one was 500K in USDT. There was a couple really big USDT ones. I saw some big AVAX USDC swap or Savers ads, and I mean that's been a really productive pool for a while because it's pretty shallow comparatively. Like it's only I mean at the most like a couple million at the very most in depth, but still gets a lot of trade volume, so it generates a lot of fees. So people have been pretty much filling up that ball. I think it's at the let's get into this a little bit. It's like pretty much like rubbing up against the cap/POL stuff, but that Bitcoin Cash deposit was I think like 350K or something like that.
Nice.
We haven't seen any massive Bitcoin ads, but I mean the yield also isn't like crazy in Bitcoin as it is for like a lot of the other pools. So yeah, you might be able to see why that would be the case. I've seen a couple mid-sized ones, and basically I haven't seen any 50 Bitcoin deposits yet, so I'm not like jumping out of my chair yet. So, but I'm sure we'll see it one day.
It is interesting to see like how just in the last like couple of days we go from having like 168 million in liquidity to like 180, 190 just in a matter of a few days, and that's like we're our TVL has been climbing pretty steadily for the last like 2 weeks.
And like, I mean, how much does some of that come from Rune's price? But like, I think TCB had like a really epic thread claiming that it was pretty much all like just intrinsic flywheel stuff, kind of like driving everything recently, which was pretty cool to see. Like savers piling in, regular LPs piling in, all that.
Yeah, no, that's definitely a part of it. So as Rune's price is performing well, and I think like Rune until a few hours ago was like the highest performing asset in the last week, and so as Rune's price performs well, it just pulls more liquidity and more Bitcoin Cash, everything. And so when we actually go crazy in the bull market and Rune's doing a lot better than it is now, hopefully, then with the depth of these pools will get really deep. Like really, really, really deep. And it'd be awesome because then the streaming swaps would be even more efficient, which is fantastic.
Yeah, so kind of related to what you're saying is POL being added for all the other L1 pools and also stable coins. So that was something that just happened yesterday or the day before, I believe. And so that basically just greatly increases the amount that can be added into the vaults because POL will scale the dual-sided liquidity to make it so more L1 liquidity can be added. So I've been seeing POL been adding into the AVAX USDC and also the ETH USDT pools, and that's just going to keep basically if there's any like Rune price decline, POL will just keep adding and essentially just adding more liquidity into those pools. Also, with the Rune price increasing against Bitcoin, it's been withdrawing from the Bitcoin pools. So we're kind of at the point where it's like a pretty interesting like equilibrium happening right now where it's simultaneously withdrawing from the Bitcoin pool. So it's basically selling Bitcoin to buy Rune, and then it's using that Rune to deposit into the two of the stablecoin pools as the price is decreasing against USD. So POL working as intended, and I think there's like about 2 million deployed right now, with a maximum of 5 million that can be deployed, and I think there's authorization to go up to 10 million Rune deployed for POL. So, a bunch more Rune can still be dumped into the pools to essentially just back the savers and keep the pools pretty full of Rune, increasing liquidity even further.
Yeah, love it. I love to get the pools deeper and deeper and deeper. The deeper they are, the more efficient the tradings are, right? Even if you do a streaming swap and there's no arbs on the other side, it gives you even better price, right? So it's just like the deeper these pools can get, the more TVL there is. The more TVL is, there's more liquidity, more trading. It's just all how it all works.
We love a good
Yeah, I don't know
flywheel.
if there's anything more interesting about POL, except that it's on and working as intended, and it's pretty slow at this time right now. Like I think since like 7:30 last night, like basically in the last like 24 hours, it's probably only deposited maybe 15,000 Rune total, because it's filling up pretty shallow pools like ETH USD, sorry, AVAX USDC. So yeah, it's less than 12,000 Rune deposited total. So it's just a little bit in USDT and a little bit in AVAX pool. So yeah, there we go. And basically that means it basically just creates room for savers to continue to deposit, and but also as the utilization there gets higher, the yield goes down. So it'll be kind of like a self-balancing thing, where if the pools are just always completely full, then those savers aren't getting any yield, and probably some of them will withdraw. So just kind of the dynamics of synth utilization and savers yields.
Yeah, absolutely, man.
Oleg posted a couple questions in the chat, which I guess we can answer. You want to read those and give your answer, Chad? Also, we can let Sharky Lightfoot into onto the stage.
I mean, we can invite Oleg onto the stage, and he can answer his questions.
But that could be a little bit easier. True.
Yeah.
And it'll be easier for the listeners.
Yeah. Invite him up.
All right, inviting him up. I'm also letting Sharky Lightfoot up here if they have a question about something. What's up, Sharky? To start.
Hey, Jim, everyone.
Yo, Oleg. What's up, man?
Not much. So I just asked a couple questions. Some of them have already been answered. Let's start with the first one. So now that we have streaming swaps making any trade very low slippage with very little liquidity, any incentives in attracting other ERC20 pools? So you know how Thor swap, we have a pool on Sushi Swap, and then Sushi Swap is kind of courting us to migrate to Sushi V3, and then there are other actors that want us to move our liquidity to their ecosystem. The goal is attracting TVL. So I know that before the kind of general idea was let's keep the pool space for L1s, to make sure to get the lowest slippage. But now that we have streaming swaps, does that change the strategy and maybe attracting specific projects or trying to get new ERC20 pools might be good for the protocol?
Yeah, I mean, I think there's been a general tone for a while of the idea of just like leaning away from ERC20s and like other tokens, and just doing cash assets and stable coins. But then we started doing this whole like streaming swap thing, and that kind of raised the question of like, well, are we going to see decent volume on these things now that we have streaming swaps? I think there's still needing more time to kind of evaluate that, but in the end, we only have so much cap space, so much security, and if we spread it out too much and have a bunch of just really like shallow pools that are just collectively take up a lot of the space and the security of the network, then it may not make sense to have them. So I think there's like some intention to increase the number of like rune required to be in a pool. Like I think right now it's like 10,000. You can't have anything less than 10,000 K. Then it becomes like a standby pool. We still want to like increase that to like 100K, something more substantial, just to ensure that the pools we do have are, you know, of subsequent size to be make it worth the while. And then there's another kind of idea that was floated at one point, and we haven't really been talking about lately, but this the general idea of like tracking the amount of trade volume in a pool relative to its depth, like how much is it collecting in fees versus the depth of the pool, and if it's like under a certain margin, a line, then it would get like kicked out, right? Because it's not really generating enough swaps for it to be warranted to take up that much space, in terms of security. That may happen at another time into the future, probably not anytime soon, but it's just like part of the evaluation of like where do you want to utilize the security of the network? Where does it make the most sense? Is it better to kick those out and get like a deeper Bitcoin pool, or is it better to have more assets or not? And I think it's a very debatable topic.
Yeah, but in a world where THORChain now executes swaps cheaper than Uniswap and is very competitive even with the changes to the network admin fee, and I don't see like people waiting for cap space on the Bitcoin pool. So does that make it like a desirable strategy for THORChain or Nine Realms or the ecosystem to adopt and try and get new, very deep and active pools? Like if we think of say the Aave token, there's already a pool there. Should we try and get that going so it's deeper and it has actually more volume just because it's more competitive than Uniswap? So why not try to get that liquidity locked into the protocol and add some value to Rune as well?
Yeah, you could do that, and it's not a bad idea or anything like this. You have to consider also some things about like, do we want the POL to be part of those types of ERC20 assets or not, right? Or do we want to keep it focused on, like the gas assets and the stables and that kind of stuff? And that's another debate we can have like within the community. Because if you don't, then you won't you don't have savers and you don't have the POL in like the Aave pool, for example. Then you're reliant on the kind of dual LPs to provide the liquidity, and then the question becomes like, well, how much demand is there for that? And you're right, you can do streaming swap with that, and arbitrage bots will probably be slower to arbitrage smaller pools most likely. But it's a good topic, and I feel very mixed about it personally.
Well, just thinking about it realistically a bit, like let's say you have a pretty, uh, let's say you have a low liquidity ERC20 pool. Every single time that there's a swap out of there, if you're expecting an ARB to come in, ETH L1 fees are pretty expensive. So unless there's an active, you need to have a pretty active ARB on those pools to even get better liquidity. And if you're relying on more L1s to be deposited, then it's going to take a lot of L1 gas fees to even do that. So like if the pool is so small that you're going to need a lot of ARB in order to maintain the price, then like would the price even maintain even with streaming swaps? Would it even maintain the price because it would cost a couple dollars to just ARB more of the asset into the pools every single time to fill liquidity needs?
Yeah, I get what you're saying. I think there are a few use cases. Like I wouldn't just call all the RC20s to look at THORChain, but I think there is a couple of strategies that could be pursued by the ecosystem. So maybe liquid state derivatives such as wrap state ETH and like bigger tokens such as, well, Uni maybe not because they have their own decks, but stuff like Maker and Aave, maybe it could make sense to see if there's interest on their end.
We do have Aave.
Yes, but it's very shallow. And I don't know how many people in the Aave community know about the THORChain pool. But yeah, that's my quick take on it. And then the second question, I'd be curious also to see everyone's take on that. But basically, I suggested a while back, and I'm not the only one. A couple of people suggested that we consider or explore if it would be possible to stake a very small portion of the pools for the POS assets such as Ethereum, AVAX, and Atom into their native protocol staking. So Lena at the time, remember saying something along the lines of the protocol should keep as much as possible chain agnostic features. So those are not chain agnostic, so should not be considered. And also that the liquidity should always be accessible. I understand those points. Just curious if there are any other takes on that suggestion.
This is like the idea of having like staked ETH as an asset on the network.
No, it's the idea of THORChain staking Ether from its pool and get like the extra yield and
Oh yeah,
distributing it to the pool and something like maybe 5% of the pool or 10% of the pool.
yeah. See, I would lean against that personally, just because that increases protocol risk. And so in the event that that thing that you're staking it to like gets hacked or something like this, and the funds are lost or become insolvent, then we become insolvent as well inherently. And then it becomes the question, well, who's going to pay for it? Is it just going to be a collective that everybody in the Ethereum pool just kind of takes the hit and eats the losses, and we just burn up. We just adjust the pool depth to reflect the new amount. Um,
Yeah, but I'm talking about like native staking. So I understand your point, but like if Ethereum native staking gets hacked, then let's consider Ethereum down 99%. Same goes for AVAX or Atom. If their native protocol staking solution gets hacked, it's pretty much any way THORChain will suffer because the assets will likely go to near zero.
yeah. Well, I don't think there's like in order to do native staking on Ethereum, and I'm not an expert here, so correct me if I got it wrong. That you actually have to run a node, right? And so that's what typically what Lido does is they run the nodes. They get like 30 of them or something like this, and you stake to their nodes. And so we would have to stake to someone somewhere, right?
I'm not an expert either, so maybe I'm missing something. I was under the impression that you were staking to the beacon chain, which was accessible whenever, yes, we run a node, but then all the Tor nodes run an Ethereum client. And I thought that was sufficient, but I might be very wrong there. Same for AVAX and Atom. I'm just not sure.
Right. I think it's like ask a good operator or a bad operator and incur slashes because of uptime or something like this. Yeah, I mean, I'm not a fan of it, but what you're trying to go for is an additional yield in the pool. That's what you're trying to go for.
And reduce the security budget, right? Because if it's staked away from the THORChain pool, then maybe it doesn't need to be accounted directly because it's kind of locked away just as the cold vaults you were exploring.
That's a little bit different because in this case, if somebody were to cyber attack the network and own the nodes, then they would be able to withdraw and unstake if they wanted to, right?
True. Yeah.
So the difference is that on cold vaults, the validators do not have an ability to like pull the funds from the cold vaults. Like there's no mechanism to do so. The people who run the cold vaults have to like opt to give it back to the network when it is economically reasonable to do so. That was like one of the reasons why I didn't do cold vaults a long time ago, because the mechanisms we had, like it would always allow the validators to like claw back the funds whenever they wanted to, and that kind of defeats the point in some sense. It's an interesting concept, and we could do something like an ST ETH pool, like a Lido ETH pool, where you can get some Lido, stake some ETH to Lido, and then get a liquid staking token, and then take that and then deposit that into a pool on THORChain, and then get a yield from that. Right? You could do that. That wouldn't create any kind of like paradoxes of like insolvencies or lost funds.
Yeah, or you just go to the next level and you create a VTOR room pool for triple reflexivity.
Yeah, could do something like that too, I suppose. Yeah, it's an interesting idea though.
Oh, that's all I had. Thanks for answering the questions.
One more thought, actually, is that like this notion, and obviously it's not the same, but like it sounds a little bit like what kind of like what FTX was doing, or BlockFi, where they take you deposit some money, the money goes somewhere else into a series of investments or trading strategies or whatever it is, and then things can go sour, and all of a sudden you're in bigger trouble than you started. Kind of like, I think one of the benefits of something like a THORChain is that you know where the funds are, and it's always in the network. It's not being re-hypothecated for other purposes and other protocols. You want to do that. There's probably some decent protocols in the Ethereum space that does that fairly okay. But I think THORChain, I think in my viewpoint, should always just stay to own what it has, and always stay solvent.
Cool. Thanks, Oleg. Is Sharky Lightfoot there?
Can you hear me?
Hey, yep.
Hey, I saw a tweet by THORChain Bull. Y'all may have covered this, so if you did, you can move on. It was about protocol own liquidity, and he said that the POL algorithm may have directed the protocol to buy exogenous assets with 500,000 rune, which caused which would have been a sell-off of 500,000 rune. And I was curious if that was accurate or if something else was at play.
Yeah, sure. So I pinned the tweet up top that I made earlier, and it's correcting THORChain Bull, who I think was just reading the charts a little bit wrong. So POL deposits liquidity, as in sells rune for the other asset, when the synth utilization gets really high for an asset, and it withdraws that liquidity when the synth utilization goes down. So when rune outperforms. So it basically what's happened over the past couple of days is rune has gone way up in terms of Bitcoin. So the synth utilization dropped below 40%, and the POL withdrew about 500,000 rune from the Bitcoin pool. That's actually rune buy pressure, not sell pressure when you're talking about withdrawing from the pool. But also what it's been doing is been depositing rune into the USDC and USDT pool. Now, if you look at it on the chart, you literally can't even see the line go up because it's so little. It's about 15,000 rune deposited versus 500,000 withdrawn. So unfortunately, THORChain Bull is incorrect about what he was saying. It's actually the opposite dynamic, and yeah, it really doesn't have anything to do with it's just normal price action and totally expected in my opinion. The 500,000 being withdrawn, that's rune buy pressure, not sell pressure. You can check out the pin tweet that I made where I kind of just go into POL, and you can check the dashboards and see exactly what happened. So it's not anything to worry about there. Just you just gotta just remember that when you're depositing rune into the protocol, you're selling half that rune for the asset, and when you're withdrawing the rune from the protocol, you have a dual liquidity position, right? So you have rune and USDC. You're selling that USDC for rune. So when you're withdrawing, you're buying rune, and when you deposit, you sell it. So we deposited about 500K rune in the past like 3-4 days, and we've deposited around 15K. So that's what happened.
Cool. I appreciate clearing that up.
Yeah, relatingly, something that I've been talking with some of the devs about on this topic was changing the POL to withdraw at a lower percentage, because right now it's like it's programmed to enter the pool when there's more than 50% synth utilization, and then it withdraws. I think at 40% synth utilization, which is why we saw that withdraw from the Bitcoin pool that Kyle was just talking about. And that's actually kind of a problem for us because if if you enter in now, right? Let's say use the fuel I'll just enter just now, and I put in like $500,000 worth of room, whatever, and then the room price like doubles or 3x's or something like this, right? The PUL will incur a certain amount of impermanent loss because the room price is deviated from the asset price. Bitcoin stays like static, room's gone 2 or 3x, and so the pool has gotten the PUL has experienced a bunch of IL because of that, and then also because the sync civilization has now dropped from 50% to something like 20% because the Bitcoin prices as the room price has gone up relative to Bitcoin. It withdraws, right? And so it's just kind of this thing of like, the POL needs to stay in the pool, like while it's in the pool and it has that IL kind of experience, that's like an unrealized loss that it's experiencing. But you got to stay in the pool to continue to earn the revenue to earn back the IL that you lost, and so it's experiencing IL and then exiting, right, and then realizing the losses. And so it's kind of like got like somewhat of a bit of a problem because it's kind of like the worst kind of LP in some ways. Like it's entering when it's a bad time to enter and leaving when it's a good time to entering when it's you should be exiting, or leaving when you should be entering. Like kind of reversing in the sense, like it's kind of doing a bad job being an LP in some sense. So it's just like, we were talking internally about like maybe we just change it so that it enters at 50% and it withdraws at like 10% or something much smaller. And we even floated the idea of just never exit, just leave the rune in there forever, just let it keep the pool deep and let it grow over time, and just let the pool just eternally grow forever, because there's an LP that will never ever actually leave, and it'll just constantly earn revenue and keep it, and then like recycle it back into the system, so it'll like always grow in the pool.
Yeah, but if you did that, then you'd run into the problem of it's just infinitely needs more and more rune to be like shoveled into this steam engine, where it's like where back in the summer we hit the 5 million rune max deposit. If we were still at the 5 million max deposit right now, we'd just have to keep cranking it up higher and higher and higher, just using, I mean, basically it would use the entire reserve in in some amount of time, especially with just an uncapped amount of deposits that it allows, essentially. So eventually it would run out, I think, fairly quickly.
No, I mean, I don't think I would agree with that, just because in order for that to happen, you would have to have like a continuous addition of savers, right? In order for that to be true, and I don't think you would have that. I think, well, maybe you're right. Who knows? But I think it's better for the protocol, for the POL, to stay in longer, and rather than exiting when it gets an opportunity to do so. Just like stay in and realize, earn more yield, and go against the IL that it's experiencing when it does see a price movement.
Yeah, it's a good point, and you're totally right that it exits at the time where it's more likely to experience a loss, because that means that rune has gone up versus the other asset, right? And
Right.
what happens when you're an LP and the one asset goes up versus the other, you're selling the strong asset into the weak asset. So you're essentially just depositing the rune and then selling that rune, and then you're just withdrawing once you've realized enough of a loss. So it's like it's essentially just like only withdrawing. I mean, it's meant as a utility, not obviously not as like a profit seeking thing, but it's like it literally is the worst profit seeking LP, because it's just depositing when rune's doing not so good, and then it's withdrawing when rune's doing well, which is like
Right.
the opposite. That's the opposite behavior you'd want if your goal was to have as much rune as possible.
Right. And another way to think about it was, we were kind of brainstorming, and is that, like, say you enter the pool now and there's a ratio between Bitcoin and Rune, like the value between these two assets. There's like let's just call it like a 5-to-1 ratio between the two of them, which is not true, but just imagine it is. And then we go into the bull market and Rune starts pumping more so than Bitcoin, because small market cap assets tend to move faster than higher market cap assets. And so you start to experience a bunch of IL because of that, but you're earning yield like the whole time, right? And hopefully you're earning more yield than the IL is doing, but that may not be true depending upon how fast Rune is moving relative to Bitcoin. And you might be experiencing some negative IL here, and maybe you're at a loss, blah blah whatever. But then, like in a few years, Rune dives because we go back into a bear market. Rune goes down partially relative to Bitcoin, as you might expect it would, and then we're back to that initial 5-to-1 ratio that we started at. And so we no longer have any more IL because IL is not a permanent thing. That's what I call it impermanent, right? Because you only experience it while the prices deviate between your initial deposit, whatever that was. And so like it eventually goes back to like the 1-to-5 ratio between the two. And now you have a zero IL, and plus you've got all the yield that you've generated over the last 2 years of being in the pools, right? And so it makes sense for the protocol to be more like dedicated. That once it deposits, and it stays there for a very long period of time, just to ensure that if it does experience any IL, that it's in there long enough that it will experience enough yield to go against the IL.
Yeah, I think I agree with you if POL is infinite, but the reserve is very finite. So like, what is there right now? 85 million Rune in the reserve, and right now there's authorization to go up to 10 million Rune. You could burn through that 10 million Rune pretty quick on a downturn, especially if you're just dumping into a bunch of stable LPs, right?
Right,
because
but
you need
what
to
happens?
put a bunch of Rune in there.
So say you have a million, you've set a max at 10 million, right?
Yeah.
And say you remove the ability to withdraw, just for discussion of the sake of discussion, right? What happens? Well, you just deploy the 10 million. That's it.
Right, you deploy the 10 million, but then you've run out of the 10 million, and the POL can't. Like that, I don't know. That's just kind of what I've been thinking about with POL. Like, is that it does have its own issue because it is a finite thing that you can't always have it there to rely on, and we saw that during the summer when we were at the hard caps and the POL was capped, and it literally could not deposit, and continue to bring the synth utilization down.
Yeah, I mean, I argued at that time we should have increased the cap on the POL. To be honest,
yeah, it's true, but it doesn't change the fact that it's still like a finite thing, and you could put in the entire reserve into POL, and then eventually that's just it,
Right, but like another way to think about it is like, say you deposited enough Rune from the POL to cover all the Bitcoin savers deposits that we have in this upcoming bull market, right? And we'll just put that number at a random number of 30 million Rune. I don't know. I'm making that up, but whatever. And if it stays in there and doesn't withdraw, and then we go into the next bull market where all the savers are depositing again, blah blah blah, whatever. That Rune asset is still there, and so it doesn't need to deploy more because it still has the Rune that it deployed from the last cycle, right? So it's not like you need to constantly always increase. It's at some point you get to a place where you don't need to increase anymore. I don't know what that number would be. I made up a random number of 30 million, but it could be some number. But I don't think you need an infinite supply of Rune to accomplish this task. You would just, like, when you get into the bear market, you would just stay in the pool, which is fine. And then when we get into the bull market, people start depositing savers, and you don't need to deposit anymore because you've already deposited. Do you know what I mean?
Yeah, and you actually hit the nail on the head with that number because 30 million is about that's about the entire pool module is 30 million minus what is already deposited by POL. So you would need about 30 million Rune to just completely change all the pools over to just POL and savers.
Yeah.
Which is about half of the reserve, though.
Yeah, and to be honest, I'm okay with that. Like, personally, like, it's like, I think one of the more difficult problems we have in the project right now, long term, is like attracting dual side LPs. I think that's the difficult task, and that's because we can only tug upon so many people for that role, right? Because you're only really going to do that unless you're bullish on Rune, probably, which the only people who are bullish on Rune is our own community, right? And so we can only tap our own community so much capital in our own community. And so like I think that's going to be one of the more difficult things to do is to kind of get more dual side LPs into the network. And I think the POL might be one of the answers for that is give it 30 million to deploy, which is what the same as what's in the network today, and that would accomplish the task of trying to grow dual side LP. I mean, if that's the case, then like the block rewards would be reduced by some percentage. I don't know what the number is off my head. Maybe a third, possibly. You can counter that by changing the emission curve if you really wanted to. But if the only LPs, imagine if it's the only LPs are the POL, and there's no more humans being dual side LPs, then the yield part of that stuff doesn't really matter anymore. Now, the block reward doesn't matter in that context much at all. And the only thing the who's getting yields is the savers and the nodes effect.
Cool. Any other? So, all right, you get one more topic for today, Chad. What else do you want to talk about?
I get one more topic. You got.
I gotta hop at 6. So
yeah, you got hard stuff at 6 o'clock. So we don't have to if you don't want to. But I think another thing that the community's been talking about is the 5 bips min fee for small trades. Have you heard about this one?
it sounds like a premise.
Like a premise?
It sounds like you're setting up for a joke. It's like, I heard them talking about 5 minutes, about 5 bips on each trade. Have you heard about this? Have you guys seen this? Sorry.
Well,
that's hilarious.
Let's hear about it.
So the nice thing about the slip-based fee model versus like XYK is that you can have fees that are extremely small, right? And because the fees are extremely small, you can correct the pool price to market price with exact precision, more so than you can on most AMMs out there. But the negative is that small traders can get like a 1 bip fee or a 2 bip fee instead of paying 5 bips, right? So hypothetically, if we were to say that you have to pay a minimum of 5 bips, still slip-based fee model, but a minimum of 5 bips on all the L1 trades, but not the synthetic trades, because synthetic trades are done by arbitrage bots. So you want to keep that untouched so that they can correct the pool price with exact precision. And just allow one trade, you would increase the fees, increase the reward into the network by about 5%. So it's to me, it's like kind of a way of like, it's a little bit more egalitarian in its approach of just like everybody pays 5 bips for all trades. That's basically what it more or less states. So it's very simple, very easy to understand. Everybody pays 5 bips for any layer 1 trades, whether it's streaming swap or whatever. Just like everything just pays 5 bips, and then you have this higher yield in the LPs and savers and nodes and that kind of stuff. What do you guys think?
Yeah, I mean, are there even that many L1 trades that pay a lot less than 5 bips? I think you had some research about split here.
It's about a 5% increase in swap fees collected by the network.
So putting it simply, is it just that like streaming swaps have gotten so damn efficient that in some cases it's below even 5 bips, and then this would set like that minimum fee such that there's just still fees going to nodes?
No,
LPs?
It's actually the opposite. It's not the streaming swaps that I'm referring to. It's the regular swaps. Because in a regular swap, if your swap is small enough that it can't be a streaming swap because the value is so small, it doesn't fit in two streaming swaps, right? That you get less than 5 bips at that point. And so if you're trading like $100 into the, going Bitcoin, Ethereum, and trading $100, that's going to be, probably, 0.1 bip swap fee in that particular example, right? Or something close to that. And so it's not the streaming swap that is the streaming swap is paying 5 bips in all cases, right? Maybe it pays more in some cases. Streaming swap always pays 5 bips. It's the single swap that's actually kind of getting more or less a quote unquote free ride, and they're not really paying a decent reward into the pools for being there and providing liquidity and doing those swaps and such. So It's
Gotcha,
just an
makes
idea
sense.
to just make sure that everybody's paying like a fair share, and it's much more egalitarian. Like the way it is now, like you're medium or you're highly wealthy and you pay 5 bips, or you're like a small shrimp who has no money and you pay 1 bip. It's like kind of like a form of welfare in some sense, right? And this would be
Yeah.
more like egalitarian, meaning that like everybody's treated the same, whether you're a whale or you're a shrimp, you all get the same fee.
Yeah, I mean, yeah, no strong opinion. I mean, sounds good to me.
Yeah, I like it too. I think if we can think about more ways to generate revenue for the protocol, like through organic trade, like real revenue, real yield. I think that's generally a good idea for the protocol for sure.
What
Anything we
did
can
you
do with
say
that.
about you said something you said something 5%? Like what is the like do you have a sense of how much of the overall volume are these small swaps? Like is it meaningful?
I actually don't know like what percentage of the swaps are small enough that they don't fit into a streaming swap. I have to imagine it's probably going to be like a good amount. I would, if I'm taking a guess here, so don't quote me on this, but I'm going to guess it to be like 20 or 30%. I'm going to guess.
Right, in number of swaps, but in like percent volume, it's probably pretty low. I'm just yeah.
Percent
I'm
volume is
also
probably
guessing. Yeah.
it's going to be relatively low, but basically any swap that's like I think it depends on where you're swapping. But if you're going like Bitcoin ETH, for example, I think it's like if it's under like $4,000 or $5,000, you're probably going to get a sub 5 bips fee or something like that. If it's over $5,000, then you're going to be doing a streaming swap, in which case you'll probably just get 5 bips.
Okay, yeah. So the threshold's not like that low. It's not just $50 swaps. It's also like $3,000 swaps.
Yes, I think I can't do the math off the top of my head because I'm not that smart, but it's probably like any swap that's like under $5,000 or something like that.
Yeah, that probably adds up.
Yeah,
Yeah.
that's why the fee would be about 5% increase per day or whatever, per year or whatever you want to call it. But and that would just be just more organic, swap fees being collected by the network. You know,
Yeah, I think as long as it's adjustable easily enough, just like an economic memir that can be changed in case there's some kind of like design consideration or like, we need to beat another protocol just by like, that 1 basis point or something like that, turn it down to four or something like that. Uh,
yeah,
Yeah.
Honestly, I don't think it really makes it probably that much of a difference in the grand scheme of things either way.
I actually saw Smith float a pretty interesting idea, which was a kind of a hypothetical, but it was like, even now THORChain has better execution than centralized exchanges and stuff, but that might even get way crazier, right? Like as just everything progresses. And on one hand, it's like it's cool to be 95% less fee or something, but maybe being like 75% less fee is sufficient. And then it's a question of could there actually be like a slightly higher fee, and then that just benefits Rune LPs, nodes, and whatever. But I thought that was kind of interesting. Like maybe it's almost like too cheap in the long run.
maybe. I mean, I think part of the point of why the number 5 bips was like selected um, was that we wanted to kind of like switch the strategy of the network, like the actual like a long term strategy of the network to kind of go more like kind of like the Amazon route, where like Amazon, as a company was producing a lot of revenue, but it was spending more than it was producing, and never really made money for like 10 years. And this is not a great analogy, but bear with me. And so by kind of switching our strategy to trying to have the highest yield possible in the pools and attract liquidity that way, we would kind of go after swappers and try to get the highest volume of swapping possible. And 5 bips was kind of like the strategy of doing that by just being able to go out in the world and just be able to send out a tweet that says, THORChain has the best price execution of any centralized or decentralized exchange in the world. It's a really powerful statement, and that can draw a lot of liquidity. And what's really fascinating that we didn't really know at the time, but we that yes, you're going to collect less fees per swap, but you're also going to get more volume because the fees are obviously so low. And in the end, the swap volume had increased by like, what was it, like 5x or whatever the hell the number is, 5 or 10x or the hell the number was. But the swap fees didn't actually really decrease much at all. So each swap had less fees, yes, but the number of swaps increased. And so that kind of counteracted the losses that you got from like having cheaper swap fees, right? Because you had higher volume. We thought that might be the case, but we were, I wasn't confident that would be the case. Like I thought that might happen, but it ended up happening. Like that's why the swap fees right now is still 50% of the system income of the network, which is even better because when we measured this before, like room was at $1, so the block reward was like 1/3 less than what it is now, and yet so before it had like kind of an advantage over now. It's still at 50%, so it's like it's totally worth it doing the 5 bips. It doesn't really actually hurt that much in terms of LP revenue. It actually generates more in the end relative to what it was before. So
Yeah. Yeah, I think the Amazon analogy is actually really good because, Amazon's like, basically shipping you products overnight for like little to no profit in most cases just to kind of like get you in or whatever. Whereas in this case, like THORChain is shipping hundreds of BTC for,
right.
essentially no fee, but enough of a fee. So, yeah, I get the ethos. It makes sense.
Decks in the world, like that would be. Then at that point, we can raise our price whatever from 5 bips to 10 bips, or whatever we want to do, or something like this, and then we'd probably stay up there.
Which could be like freaking gigantic at some point in the future, right?
Yeah, absolutely.
Yeah.
And at some point, the community can do that, and the community can do that today if they want to. It's a Mimir, so they can vote and change it right now if they really wanted to.
Yeah, it's interesting to think about for the future if TC is just so dominant. Yo, grassroots, Chris, what's up?
Hey, how you doing?
Doing good.
What's up, brother?
I just got a point for. I've just been running some tests for the what we're talking about. So the getting 5 basis points, like trying to get that, it really depends on the depth of the pool. So trying to run some numbers just now, and for a Bitcoin swap to get 5 basis points, you need to swap about 6,300 room thereabouts, which is about 11,000, and that'll get you at 5 basis points swap. That costs about $3.19, from what I can tell. So that would be if you're doing a Bitcoin swap, which I think most people do it under 5 basis points. But if you're doing an Ethereum swap, it's much less. It's about 3,200 room to get to 5 basis points. That would cost you about $4.50. So I think then that's putting what it would do for the users, putting a set price, a min price for a slip. Even if they're doing on the Ethereum pool, if they're doing a $50 swap, a 50 room swap, it will still cost them that $4.50 as opposed to even if they're doing a 3,000 one. Is that right?
Yep. I think in the case of you have to you kind of average out the two. It's not an average; it's more complex math than that. But if you average out the Bitcoin with the ETH, you come out to about 5,000 approximately.
Yes, but if you're doing a smaller pool, you're doing a BNB pool or anything apart from those two, because they're deepest pools, obviously.
Yeah,
so they're going to have the highest.
That's the deepest pool. That's what the vast majority of our trading is. Is those two pools.
Yeah, so I think it's just understanding what those minimum values are approximately.
Yeah.
That the user will pay. Yeah.
Yeah, and it's obviously a lot smaller in an AVAX swap, like we were talking earlier.
Yeah. Sorry. Daylight savings didn't know we changed. Yeah, so an AVAX swap would be 2,700 room approximately. So it's much less.
Yeah.
You need to $7,000. Yeah, I think. I mean, obviously, I do target a lot under 5 basis points. I don't usually go over 5 basis points, particularly with testing. But I can see the need. It's just, I guess, understanding what the user impact is, and then the additional income that THORChain will get, because then that would obviously increase the APR to the node operators, the savers, the LPs, the POL, and everything as well.
Right.
That's what I like to see.
Right. How you doing, Ken?
What's up? What's up? Yeah, pretty good week. Um,
Baller week.
yeah. Um, yeah, so I was actually thinking about this, like the thing that you discussed earlier, which is pretty much how to grow the liquidity pools. I'm also not that excited with like prior relying on dual LPs moving forward. I think it's like it's almost proven to to not be a great strategy, like across the board. I think across all AMMs. So we do have these like savers. We do have the POL, which is great. Um, One thing that's like that that I've been thinking is like the savers yields are very high, right? Like compared to what you can get out there. Like if you think about it,
Mm-hmm.
if you look at like AVAX or other like Atom, like those kind of assets, you don't like yields for those assets are like double digits, and like you're
Mm-hmm.
probably not gonna like get them even if you staked those tokens in there like native chains. Um, and then like you look at stables like BUSD, another USDC, etc., and then you see like again very high like yields. Even like I remember seeing like 15% yields on some stables. Um, so it is bullish in some sense because it means like the pool is generating fees and then like etc. But then it also seems to be a signal that people kind of still perceive THORChain as a like risky like primitive, especially the savings, right? Because otherwise, I'm
Mm-hmm.
thinking like people would just participate more, and you'd see those like yields being diluted as they are now. Like it's being distributed over um, more depositors, basically. So
Yep.
yeah, just wanted to open that up. I don't have any like strong conclusions here. But yeah, curious what everybody thinks here.
I think the one thing that makes you're right. Like a lot of AMMs, their model doesn't really make a lot of sense in terms of like as a strategy, like as an investment strategy. Like Uniswap V3 is kind of like one of the worst. Like almost 60 or 7% of people who LP on Uniswap V3 are at a loss just because of concentrated liquidity and all this kind of stuff. But I think what makes THORChain a little bit different and maybe a little bit of a tastier kind of situation than a typical AMM is that because they have savers and especially as we're entering into a bull market, as we get further down into the bull market and Rune's naturally going to be outpacing USDT or outpacing Bitcoin or whatever. You're basically taking revenue, you're taking value from the savers, and you're giving it to the dual side LPs, and so you have this kind of like higher juices in terms of like yield for those dual side LPs that you don't have on regular AMMs because we have our savers product, right? And so you have block rewards, you have swap fees, you have streaming swaps, you have all these things like generating, like even lending is generating revenue for the LPs, and then on top of that, you're kind of like taking some value from the savers because the value of Rune is outperforming the value of the other asset. So that's a very different kind of equation than what most AMMs do, and that might make it more appetizing.
So
But
actually,
it is also
on that note, I've been like that part of it has been exciting me for a while now, and now that like Rune has pretty much outperformed the market for the last like 90 days. I'm starting to see some like really strong like results from dual LPs on Twitter. Um, so my anticipation was that like as those come up, people would be like, oh, how does that even possible? And then like the reason is pretty much all those factors, right? Like um, the positive IL that happens in the pool that's being captured, etc., etc. So yeah, maybe seeing those results now will encourage more people to do LP. But then again, it's like very sensitive to room price, which is not a bad thing, but it is sensitive. Like it goes both ways.
Maybe instead of causing it positive IL, we call it impermanent profit.
I struggled.
I'm very
I
familiar with
actually struggled to find a term for this, and then I'm calling it positive
impermanent profit.
IL, basically. Yeah.
No, it's not losses though. It's not positive. It's positive loss. Is that what you're saying? It's profit. So it's impermanent profit. Is what it is. That's
IT.
probably the best way to describe it, actually.
IT. Yeah.
Impermanent profit. Oh my god, that's hilarious. I don't think I've heard a
But my
funnier thing in
question
a
was
while.
more so on the saver side, right? Because savers don't have to deal with any of this math, like
Right.
rocket science math.
Right.
They just deposit and they look at the yield, and all they have to do is like how much risk I'm taking and like what kind of yield I'm getting. And it's surprising to me that still like with those digits, double digit like yields, like I would expect that there would be more savers by now, basically, to be very honest.
Yeah, I mean, I assume that's because of a couple things. Like one is it's bear market, and people aren't as engaged, especially looking into like new projects. Like people might be tied down and like in their tribe, whatever tribe that is, and like just trying to survive the bear market and not looking for new opportunities or new things. I think that's part of it. I think the other part of it is, and this is like, I don't know, this is just me, I have a very different view on this because I'm from the inside and it might look different on the inside than it looks on the outside, and I just don't get it. But I feel like because THORChain does things that are so significant, like the things that we claim as a project sounds ridiculous, right? Like anybody who doesn't know much about THORChain, but here's what this new project that can do savers and these new lending protocol and swapping across chains, like all those things like sound kind of ridiculous and like not true. And so like it must be a scam. It must be a something like this, and they write it off as like just some scam project who's trying to sell snake oil or something like this, and so people just don't believe it to be like a reality. Am I the only one that feels that way? Because that's the way it feels to me.
I think both those make sense, and I think it's part of both of those. And yeah, I mean, they kind of go together too. It's because like ultimately time is passing, and THORChain is racking up Lindy points the more we move forward, and then THORChain will be more Lindy by the time people are more degen again, and that could be a good recipe for people to really pay attention. But yeah, I think it's kind of a combo of that. Like one doesn't seem like people are super like yield degenning. At least I don't know. That's not on my radar as much as it was for sure. So I would imagine a lot of, except for the really hardcore, yield. What do you call them? I don't know. Yield seekers are.
Yeah.
But yeah, makes sense. But yeah, I mean, I do think people think THORChain stuff kind of almost sounds too good to be true in a sense.
I mean, it definitely sounds like you tell people you have like no interest, no liquidation loans. People just don't even believe. Like I've had conversations with people at conferences and whatever, and they're just like look at me like I'm fucking psychopath or something like this. I think another thing interesting is that like if you can stake your your AVAX token or your Atom token or something like this, even if you get a higher yield on THORChain, you might opt to stay in the within your own ecosystem because you have inherently probably more trust in whatever ecosystem you're coming from to some new thing that's on the outskirts, being THORChain in this case. And so maybe that there's just like more trust in your chain because you're a big buyer and you have a big bag of Atom or whatever the hell it is, and you're not aligned as much with THORChain, and so you have inherently less trust for that protocol, so you're less likely to want to deposit your tokens there.
I actually have one theory that is almost the same as that, but it's that the people that know the most about the THORChain products, like savers, are the people that are super into THORChain and Rune, and therefore are already so exposed to any risk of the THORChain ecosystem through their fat rune bags, that then it's like hypothetically you have a portfolio that's 50% rune and 50% Bitcoin. You're 50% exposed to THORChain risks. Okay, now you put your Bitcoin into savers. Now you're 100%, right? So it's like the people that are the most into THORChain are also kind of like hesitant to. At least I've felt that, and I think some others have. So I think that's part of it too. Is like savers is a product for the people that are not necessarily huge rune bulls. It's just a great product for like other people, you know?
Right, which is what it was kind of designed for, in a sense.
Yeah, that's a great point. Actually,
Totally.
This is exactly how I like. You described my situation pretty much. Like I'm already super exposed, so there's not much sense for me to also increase my exposure to savers. But yeah, I think that was a great summary.
The interesting thing is that like it's at some point I think that's going like the trust in THORChain is going to shift. Like FTX is kind of a good example of this. Is like it's just something that existed that got really big, and when something is really big, people just stop kind of asking questions, and people just stop, thinking. Like they kind of just like, oh, it's like FTX. It's like one of the biggest exchanges in the world. Like, I'm sure it's great, right? And even investors who were investing into FTX like didn't do any kind of due diligence. They're like, yeah, it's FTX. They're huge, so they're fine, right? This is kind of this mental dissonance in that sense of like questioning things when they're small, but then not questioning when they're big, right? In some sense. And so like I think if once THORChain becomes more of a kind of a household name, quote unquote, and where you become, a top 20 or top 25 asset, there's this inherently, the bigger we get in terms of the space, inherently we get more trust because of that. And with the more trust becomes more people who are willing to do deposit savers. Does that make sense to anybody?
Yep, definitely.
Yeah,
that's a great point.
So maybe like we don't need to convince people of savers. It will just happen on its own. It just comes with the success of the project.
Yeah,
and
I mean, to some sense, like that happened this week, right? Like I've seen some large, like some large participation from like Adam, if I'm not mistaken, that AVAX 2. I might be mistaken though. On savers, like I've definitely seen like 300,000 or 50K or 350K Adam participation in savers. So yeah, there's definitely like there's going to be that cycle where people kind of wake up to that, and then from there, I don't think that many people will scrutinize it. That's possible, definitely.
Yeah. Well, we'll see. I mean, it's kind of funny because we might kind of sit here and kind of question about the future of savers, but at the same time, like it's been doing well. like we every day there's more savers and there than before. Like right now we have 25 more savers than there was yesterday, and we have about $1 million in savers today that wasn't there yesterday. So it's just like it is kind of funny that it's like that we're kind of questioning savers in some sense, but at the same time it's been performing like pretty consistently and going up and to the right, like fairly evenly, right?
Yeah, I mean, a comfortable pace is not a bad thing, right? And like if it was going insane, then we'd be like bumping up against the synth caps constantly. Like maybe POL would be maxed out. That's like leveraging the LPs a ton. Like overall, the protocol is kind of like safer, you could say, when it's a lower percent synth utilization, right? Like so, yeah. I mean, it doesn't have to be like going at absolute max acceleration all the time.
Yeah, I mean, I kind of assumed at some point that would happen, to be honest, just because the value proposition of savers is like just so delicious, and it just all that it requires is just like the industry to wake up and be aware of it, and then we would see huge, like there's such demand for it. Like,
well, another point, I think you guys mentioned this on the last space that I wasn't here, but you guys were talking about just how there's a good amount of swap integrations, but there's really not that many savers integrations still right now. Right. So there's no like trust wallet doing savers yet, or there's no like gigantic centralized exchange or something like using savers on the back end. There's no like BlockFi 2.0 powered by THORChain savers or something like that. So, when I'm sure that feels like a matter of time until those things do roll out, like, whenever the market is kind of fully back and seeking those things. But
Right.
I would guess that's when you kind of see like, because yeah, again, right now, like the people using savers are the people, listening to these spaces, they're like super tapped into what's going on with THORChain. But in the future, if they just like open up their random crypto app and it's like earn 2% on Bitcoin and they just like, click it, then that's pretty,
Right.
that's going to be a lot of growth.
Yeah, I mean, imagine that's kind of an interesting way of getting around the trust problem in some sense. Like, imagine you open up your trust wallet and it says, "Hey, stake your Bitcoin for 2% yield," or something like this, or whatever the hell it says. And it doesn't even say there that it's like powered by THORChain. It just says, "Oh, trust wallet now has a staking mechanism for Bitcoin," whatever the hell that even means. And then people just like click it because they know trust wallet, they use their wallet, they like their wallet, they have trust wallet. Trust wallet has their trust. They trust the wallet, and so they click the button and they stake, because they like Trust Wallet, and they have no idea that THORChain is actually like involved in this whatsoever. And then all of a sudden, you get like a massive amount of Bitcoin being deposited into THORChain just because Trust Wallet white labeled the service, and then earn a bunch of revenue on affiliate fees.
Totally. Or I remember one idea that was floated way back was like maybe this would be more on like even a centralized front end or something like that, but having almost like an insurance fund or something that like guarantees it, but then they're taking, who knows, half the yield, whatever it is. Like maybe it's 1%
Right.
instead of 2% on Bitcoin, but then they're like, oh, we're like, this is how it's working on the back end, but like we're also guaranteeing whatever, like protection or something like that. So you're not just
Right.
like YOLOing into DeFi protocols on your own, but it's kind of like packaged under this wrapper for normies, if you will.
Yep. Yep. Yeah, we looked into all sorts of like insurance systems into THORChain back like a couple of years ago, and nobody's really willing to provide it. To be honest with you, like if they do, it's some sort of ludicrous cost that it doesn't make any sense at all. It's like you can
Yeah.
get insurance for your own LP position on some AMM or something like this if you want to, but try to insuring an entire protocol of all its assets is not something that any insurance company that I've spoken to is willing to do.
Sure, yeah. I remember when people were looking into that, but in this case, like maybe it would just be like a centralized exchange is just ensuring like their users deposits, right?
Yeah, possibly.
So maybe that could work. I don't know anything
Maybe.
about insurance.
Yeah. I don't know, it could work potentially. Like get insurance and get half the yield, and we'll cover the cost if this is lost or whatever. But then again, I don't think a Trust Wallet or a Coinbase or whatever would want to like put their faith in another project's hands, right? To put them on the hook for 100 BTC or some, or 1,000 BTC or some number of the hell it is. They wouldn't want to be on the hook for that, and when they don't own it or control it, or that kind of stuff.
Yeah.
I don't know, but somebody could do it if they wanted to. One last topic I thought would be kind of interesting to chat about is the idea of like enabling streaming swaps by default, so that basically everything, and you can still do a regular swap if you want to. You can just like configure that particular memo and have a regular swap if you really want it. But like just to get as many swaps in the streaming swap context, to start like using the network as much as possible. What do you guys think of that idea?
I think I kind of see that being undesired in crisis type scenarios, and crisis as well as like really hyped, like a launch or something like that, where like people really want to rush. They don't care about the quality of execution, but they just want to like get their asset. So yeah, the optionality of a regular non-streaming swap is a good idea to me. However, as like a software default, yeah, like UI, I'm all for like UIs just offering streaming swaps by default.
Yeah.
But then maybe like you'd be
Yeah.
just a bit of an advanced user and change it in the settings or something like that.
That's a great point. Like, even if it wasn't some crisis that was THORChain related, but just like a general market, just a highly volatile time, and people are just there's tons of activity and prices are moving like crazy. If your swap is taking 2 hours instead of like an hour with the outbound delay or whatever, then like you're exposed to that price volatility. So I could definitely imagine scenarios where people wouldn't want that.
Mhm. Yeah, I think having the optionality to use a
Yeah.
non-streaming swap is still important.
But
And
as a default, yeah.
as a
I
default,
mean,
I think it makes sense to me just because you want to get all the UIs that simultaneously are now using streaming swaps, and now all of their volumes. Like I think like Trust Wallet switched to streaming swaps, and they I think like doubled or a little more than doubled the volume from their UI, according to what TCB said on Twitter a while back. But like,
so how do they show it? Do they show an option or do they just show a single quote? I haven't seen it.
I haven't seen it either. I haven't tried it myself, but I think they just defaulted it. I don't think they even show an option for
Right.
like a faster trade. And to be honest, like the difference between a streaming swap and a non-streaming swap is like fairly small when you do like one block intervals. It's like it's especially for like a Bitcoin trade where the Bitcoin block time is 10 minutes, right? So it really doesn't make any difference whether it's from a speed perspective, whether it's streaming swap or not.
Yeah.
But if we can get all the UIs to simultaneously just to use streaming swaps by default, I think a lot of the UIs will just increase in volume by a good amount, which would in turn would cause not only just more volume in THORChain and it becoming moving from number 6 to number 5 or number 4 on the DEX list, but also generating I think would generate more revenue for the LPs.
So if it was if the option for a non-streaming swap was still there in the protocol, like how do you imagine that being shown? Because like I'm looking at THORSwap right now, and it does. I mean, it gives you the two options, but it already defaults to the streaming swap, like when that's advantageous, and it basically just disappears when it's not. So in a way, that's already defaulting to it. Like you have to like click on a different route that shows you a worse price to not do it. So
this isn't for the THORSwap because THORSwap's already got some shit together and such, but it's the other UIs that are a little bit slower to adopt that are still using the a regular swap mechanism, right? So those are the ones we want to kind of almost force them to upgrade to a streaming swap design in some sense.
Got it. So that makes sense. So it's like then like right now you do a normal swap the normal way, and then you do something special to do a streaming swap. This would basically just reverse that for the way that they're designing the UIs. Like it would be streaming swap normal, do something slightly special to do a non-streaming. So you'd get all the people that are not, or all the interfaces that are like not offering both already.
Right. Although maybe my whole hypothesis is actually wrong, just because even if you say Trust Wallet wasn't doing streaming swaps, they were just doing only regular swaps, and then you force them to do it through a streaming by default kind of thing. But then their quote system is still going to be quoting the regular swap and displaying that to the user, not displaying to the user the streaming swap price, right? So maybe it wouldn't actually generate the additional volume because people still think they're going to pay a much higher fee than they actually are going to pay. So they walk away from the deal because they think that they're going to pay 80 basis points. In reality, they would have paid 5, and they would have stayed if they knew that. But the UI displays the wrong fee.
So could that default just be switched as well? Like could the default quote just be the streaming swap quote?
Yeah, I think so. I think right now, I think in the quotes endpoint, there's like 2 quotes. There's like one that's like streaming and one that's not streaming. That's like given when you make a quote.
Just want to say with AsgardX, we show default on streaming swaps, and we show you the difference you get, like the benefit you're going to get with streaming swaps enabled. And then you would have to explicitly put the interval to 1 in order to get an instant swap, to force an instant swap. So I think it's the best way because users really just want to concentrate on their, what am I putting, what am I going to get at, and when am I going to get it. So you want to default that to the best experience you can get, I think.
Yeah, I suspect long term that like we'll just get rid of regular swaps in the long term, just because I don't think anybody's really going to want to use it, to be honest. Even in times when you want faster execution, you're probably not. You're probably going to get, you wait an extra 6 seconds to get half the fees anyway.
But
Like, is 6 seconds really big of a deal?
but imagine like yesterday, Tia, like Celestia just launched, and then they did like their almost like the price discovery of the token happened at first in Osmosis, right? So a lot of people were just like basically rushing through Osmosis, relayers overloaded, etc. So they had a lot of problems. So I was just thinking, like, how would it play out if THORChain implemented it, and like streaming swap wouldn't be the right fit for that kind of launch, for sure.
Well, you ready for me to blow your mind, Cam? You ready for this?
Yeah.
So imagine a crazy world where THORChain supports limit orders, which is already existing in the code today. And you have an ability as an ARB bot to ARB via a limit order. And so you have this potentiality of being able to do a streaming swap and execute 10 trades in the same block, right? So you get the streaming swap price, but you get the regular swap speed. You see what I mean?
So there will be, let's say, 10 swaps, but all in same block. Sorry.
All in the same block.
And different prices.
Yeah, I'm not quite sure how that would work, but assuming there should be, if there's a limit order of an ARB, the ARB puts up a limit order of some value, the stream swap just executes against that in effect. And so
So you're getting.
push.
So go on.
That's what I was going to say. So you're pushing the price, down or up, whatever direction we're going, and then the limit order pushes it back, and then you do another streaming swap, and the limit order pushes it back, and the limit order pushes it back. So as long as there's enough liquidity in the limit order, that the ARB is set up on this, it's more like active arbitration versus passive arbitration, or we want to call it reactive versus active. Like you could theoretically, I think you could theoretically have streaming swaps and do like 10 swaps or whatever within a block. So you get, it should be like just basically the same speed as a regular swap, but the fees paid as a streaming swap. You get the best of both worlds at that
So the
point.
streaming swap executes in market price, and then the counterparty to the trade is the limit order.
Yes. So because when you make your first sub swap, you push the price up 5 cents. I don't know. I'm making random numbers. But then the limit order wants to sell at that price or something like this. It pushes it back down, right? And then the sub swap executes again, pushes back up to 5 cents, and the limit order pushes it back down. There's like a streaming swap against it. So you have like two streaming swaps battling each other effectively. Right, and once one swaps and then one swaps back, one swap the other swaps back. It's swapping against each other, back and forth, and then eventually you get like a streaming swap within a single block.
That's so cool.
It's pretty
Sorry,
mind
guys.
blowing.
I gotta end the space here. So sorry about that, but I would love to talk more about like all the limit order stuff at another point because I think that's a really interesting idea there, especially proactive ARB and things. But gotta wrap it up for right now. So,
all right, guys.
No worries. Good stuff.
Think on it, guys. Think on it.
All right. See you next week. Peace.
Bye, guys.
See ya.